So Wall Street is currently busy repackaging this massive artificial intelligence build-out into some incredibly complex financial structures. And I want to start off with a direct warning from analysts who are watching today's markets closely. They're saying collateralizing things we shouldn't is literally what happened in 2007. That's a pretty heavy statement, right? It really forces us to ask, are we engineering our way into this brilliant, unprecedented technological future, or are we quietly building the exact same structural trap that triggered the subprime mortgage crisis?
Well, welcome to this explainer. Today, we are unpacking the NVIDIA AI finance crisis and the sudden rise of these things called collateralized compute obligations. We're going to take a really objective look at whether this massive financial boom is just locked into predictable catastrophic failures, or if by utilizing some highly advanced frameworks, it can actually engineer assured ROI success. Okay, let's take a quick look at our roadmap. We'll trace the AI finance gold rush. Then we'll decode the risks of CCOs and CDS structures. After that, we'll dive into the economic reality of night-in uncertainty, compare backward AI with forward AI, and finally, look at Dr. Yogesh Malhotra's paradigm-shifting solutions for engineering assured ROI outcomes.
All right, let's jump right into Section 1, the AI finance gold rush, and how capital markets are rushing to fund the hyperscaler boom.
To really ground us in reality here, just take a look at this staggering number, $1.25 trillion. That is the estimated capital expenditure currently surging from hyperscalers, the giants like Microsoft, Google, Meta, and Amazon. The physical world of massive data centers, energy grids, and raw silicon is literally struggling to keep pace with all this digital demand. And to finance that massive gap, well, Wall Street has stepped in with a totally novel financial innovation.
And that innovation is called the CCO, or Collateralized Compute Obligation. Put simply, Wall Street is taking future compute demand and converting it into present-day financial collateral. So instead of borrowing against corporate balance sheets, they are actually bundling up physical AI infrastructure, specifically those high-performance GPUs and data center lease contracts, and securitizing them into tradable assets. Which brings us to Section 2, CCOs, the next CDO. Let's see how this repackages tech hardware risk.
Just like the collateralized debt obligations of 2008, CCOs pool underlying assets and then slice them up into different risk tranches. You've got your senior AAA tranches sitting comfortably at the top with the first claim on any cash flows, moving all the way down to the highly vulnerable equity tranches at the bottom, which are practically designed to absorb the losses first.
But here is the absolute critical vulnerability in all of this. Back in 2008, the underlying assets were houses. Those are durable physical properties. Today's CCOs are backed by silicon chips. Mortgages had historical recovery rates of around 40 to 60%, but the recovery rate of a 3-year-old GPU? Let's be real, that chip ages like milk. Its recovery rate is entirely unproven, and that's compounded by extreme market concentration, where everything is essentially reliant on a single vendor, NVIDIA.
So, the whole issue boils down to technological obsolescence. High-end GPUs are replaced by newer, vastly faster architectures every 12 to 18 months. If an AI lab happens to default on its lease, the financial models just assume those repossessed GPUs can be sold off to recover costs. But if a brand new chip has already rendered them totally obsolete, that asset's value could plummet near zero, which would instantly wipe out the lower tranches of the CTPO.
Let's move on to Section 3, the CDS contagion risk, and how derivatives are multiplying the danger.
If the underlying collateral is rapidly depreciating tech hardware, you have to wonder how financial engineers are hedging that risk, right? Well, enter the CDS. A credit default swap acts essentially as an insurance policy. A buyer pays a premium, and if the CCO actually defaults, the seller compensates them. In theory, this protects investors from those high risks of tech hardware depreciation. But in practice, derivatives have a habit of taking on a life of their own.
The potential contagion channel here is incredibly complex. CDS protection is being layered at multiple levels, all the way from corporate hedges on hyperscalers right down to specific CCO tranches. And the real danger is what's called basis risk. You see, shorting a hyperscaler's corporate debt doesn't perfectly hedge against a localized data center defaulting just because GPU rental prices suddenly plummeted.
And the entire system becomes truly precarious when you introduce naked CDS speculation. This essentially allows investors to place massive bets against AI infrastructure without actually owning the underlying CCOs at all. We have to neutrally observe the historical parallel here. This is the exact dynamic that led to AIG's $182 billion collapse back in 2008.
unanchored derivative bets create a ticking time bomb if the underlying growth decelerates even slightly. This realization brings us right to Section 4, Nietzschean Uncertainty and Risk, the post-AI framework. Why are traditional Wall Street risk models fundamentally ill-equipped for this AI boom? Well, as Dr. Yogesh Malhotra highlights in his pioneering research on AI risk, we really have to look back to the economist Frank H. Knight. Traditional finance models measure risk based on historical probabilities, like predicting mortgage defaults based on decades of housing data. But AI infrastructure operates in a realm of true uncertainty. You literally cannot accurately calculate the depreciation of a GPU when the technology that will ultimately replace it hasn't even been invented yet. Relying on historical data to manage cutting-edge AI financial risk is quite literally like driving a speeding car while staring exclusively into the rear-view mirror. Dr. Malhotra makes a compelling argument here. If we treat unmeasurable, highly dynamic uncertainty as if it's just predictable historical risk, a crash isn't just possible, it's practically guaranteed. Let's transition to Section 5, Backward AI versus Forward AI, the ultimate paradigm shift. Dr. Malhotra points out that backward AI, which actually includes our current GenAI and LLMs, leaves risk management decades behind. These systems use statistical pattern matching, like stochastic gradient descent, just to predict the next token. But in high-stakes environments filled with radical, rapid change, these algorithms are, by their very design, predictably designed to fail. So the crucial turning point is moving toward forward AI. While backward AI fails completely when confronted with black swan disruptions or entirely novel events, forward AI shifts the entire foundation over to causation and the actual anticipation of surprise. Instead of just blindly extrapolating the past, forward AI is engineered to reason about emerging futures, which makes it remarkably resilient against strategic adversaries and allows it to thrive in environments of total uncertainty.
Finally, in Section 6, let's look at engineering assured ROI outcomes and how we can actually mitigate this systemic risk. The tangible, real-world implementation of forward AI is found in QASNs, or Quantum Augmented Self-Adaptive Networks. Dr. Malhotra engineered these post-AI quantum networks specifically to overcome the fatal limitations of traditional machine learning. They provide the agility, the energy efficiency, and the resilience absolutely necessary to handle real-world complexities that happen outside the highly controlled environment of a lab. What we're seeing is a shift from basic, purely data-driven neural networks over to human-centered, agentic AI systems. By utilizing quantum principles, like superposition, to evaluate multiple states simultaneously, QASNs allow enterprises to execute true model risk arbitrage. Basically, they provide the ultimate edge over traditional algorithms when the financial environment becomes highly volatile.
Ultimately, to prevent this $1.25 trillion AI infrastructure boom from devolving into the next catastrophic debt bubble, global AI security, governance, and energy efficiency absolutely cannot be afterthoughts. The financial system has to decouple its reliance on historical correlation and adopt these proactive, outcomes-driven strategies. It's really the only way to ensure real return on investment in the face of such rapid technological obsolescence.
As Wall Street continues to eagerly securitize the future of compute, I want to leave you with this final thought. In a landscape defined by radical discontinuity and rapidly depreciating hardware, are your risk models and AI investments driving the future through the windshield, or are they heading for a predictable crash while looking exclusively in the rearview mirror? Thank you so much for joining me for this explainer, and remember to keep questioning the models that are building our future.